Have you ever wondered what happens to the value of a company's brand new equipment after a few years of solid use? Well, today, we're going to pull back the curtain on some really important accounting concepts that tell a company's true financial story. We're talking about depreciation, provisions, and reserves. And trust me, understanding these can completely change how you look at a business.
Okay, so let's start with a really simple question. Imagine your business buys a shiny new machine. A year goes by, it's been working hard, maybe a newer model has even come out. Do you think it's still worth the exact same price you paid for it? The answer is pretty obvious, right? No way. But the real question is, how do companies actually account for that drop in value on their official records?
And that's exactly where this idea of depreciation comes into the picture. So let's get a really clear definition, because it's about so much more than just an asset getting a little older.
Okay, the key thing to get here is that depreciation isn't some random guess. It's a planned, step-by-step reduction of an asset's value in the company's books. This covers the usual wear and tear, but it also accounts for something called obsolescence. When it becomes outdated because new technology has made it less efficient. Now, here's a really important point. Depreciation has nothing to do with what you could sell the asset for today. That's its market value. Instead, it's an internal accounting process to reduce the asset's value on the company's books. You should think of it as a business expense, just one that's spread out over the years the asset is actually useful.
So you might be thinking, why bother with all this? Is it just for accountants to play with numbers? Absolutely not. Calculating depreciation actually has some very real-world impacts on a business. Let's take a look at why it's so important.
It all boils down to these three critical reasons. First, it helps you match the cost of an asset to the money it helps you make, giving you a much better idea of how profitable you really are. Second, it ensures your financial statements are honest and reflect reality. And finally, and this is a big one, it matters for taxes, since depreciation is an expense you can deduct.
This quote says it all, really. It perfectly explains something called the matching principle. I mean, if a machine is going to help you make money for 10 years, it wouldn't make sense to count its entire cost as an expense in the very first year, right? Instead, you match a part of its cost to the revenue it helps generate each and every year. It's simply a more accurate way of doing things.
All right, so how do we actually do the math? Before you can calculate any numbers, there are three key pieces of information you've got to figure out first.
First up, you need the asset's total cost. And listen, this is not just the price on the tag. It includes every single rupee spent to get that asset ready to use. We're talking shipping fees, insurance while it's on its way, and even the cost to install it. It's the whole package.
Next is its estimated useful life. And this is a really key distinction. We're not talking about how long the machine could physically last. We're talking about how long it can be used profitably by the business before it just isn't efficient anymore or becomes obsolete.
And finally, you have to estimate its salvage value. This is just a fancy term for what you think you could sell the asset for at the very end of its useful life. Think of it as its scrap value, or maybe what you'd get for its parts. So when you put it all together, it's pretty simple. You take that total cost, you subtract the salvage value, and whatever's left is your depreciable cost. This is the total amount that you're going to spread out as an expense over the asset's useful life. It basically represents the total value the asset is expected to lose while you own it.
Now, once you have that depreciable cost, there are two main ways to spread it out over time. And the choice isn't just random. It usually depends on the kind of asset you're dealing with and how you use it. Choosing the right method here really matters. The straight line method is super simple. You expense the exact same amount every single year. It's great for assets that contribute to your business evenly over time, like, say, office furniture. But the written down value method is different. With this one, you take a bigger expense in the early years and less later on. This is perfect for things like cars or heavy machinery, where repair costs are low at first but get higher as they get older. The smaller depreciation charge later on helps balance out those bigger repair bills. Makes sense, right?
Okay, so depreciation is all about accounting for the value an asset has already lost. It's backward-looking. But what about getting ready for the future? That's where two other really important tools come in: provisions and reserves. So many people get these two mixed up, so let's make it really clear. A provision is for a liability you know is coming, but you're just not sure about the exact amount or exactly when you'll have to pay it. It's a charge against your profit for a cost you expect. A reserve, on the other hand, is when you choose to set aside some of your profits, not for a specific bill, but just to make the company financially stronger. So,
A provision is like preparing for a specific bill, while a reserve is more like building up your savings account.
A classic example of a provision is for something called doubtful debts. Let's say your company sells things on credit. You know from experience that a small percentage of customers just won't pay up. You don't know exactly who it will be, but you can estimate the total loss. By creating a provision for this, you're making sure your profit numbers aren't too optimistic.
Reserves, on the other hand, are all about building up financial muscle. A company might create a general reserve just to have a safety net for a rainy day, or maybe a specific reserve for a future goal, like opening a new factory. It's all about being prepared, both for grabbing new opportunities and for surviving unexpected problems.
So, next time you look at a company's financial report, you'll see a much deeper story. Depreciation tells you how they're managing the value of what they already have, but their provisions and reserves, that tells you how they're preparing for what's coming next. And together, they give you a really clear picture of a company's financial health and its wisdom.